So, Sean, welcome to Matthews. And as you're taking over the CIO responsibilities, we thought it might be fun just to go through some of your views on the markets and where they might be similar to mine or how they might differ. And I guess for me, what has been uppermost in my mind over the last year or so has been the inflation problem around the world and how the Fed has reacted to it. And I've always thought that inflation was getting under control in the US and that we might see some better news on that front and maybe even some interest rate cuts in 2024. What's your picture on your view on the inflation picture?
Thank you, Robert, for your welcome. Yeah, I tend to agree with you. I mean, I think inflation in the US has gone through two parts really. Initially, after COVID, it was really the demand side that goods weren't being produced, but then we've got through that cyclicality, and then in the last year and a half, it's really been on the service side, and also driven by the labour markets. That people weren't really incentivized to go back to work. And people had to companies had to pay up for employees, etc. I think both measures are beginning to dampen now. I suppose the question the markets are looking for is how far they dampen. Do they go back to historical inflationary levels, which, given the Fed target was always 2%, and actually inflation really averaged about 1.5%. It was always below the Fed target. Where will it end up? But I would agree that by the end of next year, we should be looking at inflation certainly around the sort of 2.5% to 3% mark.
And we're all of us, aren't we, obsessed about what the Fed does? But it seems to me now that China has a lot of its future in its own hands. It seems to me a chronically understimulated market at the moment. So maybe we should be paying more attention to the PBOC.
Yeah, I think when I first started doing emerging markets in Asia, someone said to me, the two most important things you need to know are the housing market in the US, because that generally sets US monetary policy, and the property market in China, because that sets the growth rate of China. And I think both are fairly true. I think, firstly, Fed policy will affect some parts of EM and Asia, and particularly those with higher interest rates. You got markets like in Latin America, where if the Fed does cut, they can cut quicker, and that would be quite positive. But in Asia, really, I think a lot of it's going to be doing, is driven by what the domestic policy is. So both what's happening in India in terms of the pace of their infrastructure, etc., and how much they spend on the growth of that, and then in China, it's going to be driven by what the Chinese government do. If you break that down sort of into three areas, you've got the manufacturing side of China, which is, given we're going to see a little bit of a slowdown in the US, is probably not going to grow as quickly as people expect. Then the other two areas, which is property and domestic consumption, I mean, they're purely a function, as you say, of the government going from a tight policy to a looser policy.
And Iran has been surprisingly resilient, given the fast pace of rate rises. Are there things you've seen in the broad emerging markets over the last year or so that have impressed you and sort of influenced your view going forward?
Well, I think that emerging markets have dealt with the COVID crisis, much better than they have with previous crises. And I think some of the riskier ends of emerging markets, the central banks are a lot more coordinated with the Fed. They're a lot more responsive. They understand their currency policies more, and they've actually gone a big way to eliminate big risk.
And yet, Sean, the problem is that the US keeps churning out the earnings growth, and people question what is the role for emerging markets at all.
Yeah, I mean, the outlook for emerging markets, I think, is better than it has been for the last 10 years. But the last 10 years have been challenging. And particularly, it's not just emerging markets, it's been anything but the US. The US has performed well because the earnings growth has been very solid. In the last 10 years, the US has had a much superior earnings growth and return due to that. And a lot of it's due to innovation, etc. You've got to think, though, that looking at the earnings projections of the next couple of years from the market, that they're coming down. So, we're not saying that the US won't return positive returns over the next couple of years, but they're going to be a lot harder to get, and a lot smaller in magnitude than the last 10 years. The other side, Asia hasn't helped itself. I mean, earnings have been quite tepid, particularly in China. But we do think that, Asia is sort of cyclically going to be picking up. The growth rates in Asia are good. They've just been a couple of years after COVID because they came out of COVID late, and they didn't get the same sort of support. We do think that China's sort of changing the earnings, as China starts to pick up economically next year, we would see better earnings projections. And then we've got markets like India, Indonesia that, are really beginning to put in some very good earnings growth, through domestic demand, etc. But why would investors switch? Well, one is really the earnings, relative earnings. The other is diversification. But the main point I think people tend to switch for is the US dollar. And if the US dollar's had a particularly strong period, if we're right that inflation is under control or somewhat under control, even if it stays a little bit higher than average, that rates do start to come down or certainly don't go up further. Maybe the government spending in the US puts pressure on the fiscal side and the dollar starts to slip, then that's a very, very positive environment for international. And I think emerging markets and Asia, and particularly some countries, can really benefit from that.
Well, let's take a little bit of a tour around some of these parts of the emerging market universe and maybe start with Latin America. I've been impressed with Mexico over the last few years. It's put its sort of fiscal and monetary house in order, and the companies tend to be pretty high quality. And we recently had an election in Argentina. What do you think about some of the macro environment in LATAM?
Well, I think, the good thing about LATAM in this sort of cycle was that LATAM was really badly hit by COVID. It came out of, COVID spread for longer, didn't get under control as quickly. But central banks dealt with things incredibly well, and they put rates up, and they really tried to stop aggregate demand, and they really controlled inflation. And in the past, you'd expected a lot more volatility. Now I think we've got a situation where inflation is lower in those countries relative to history, and rates can start to come down. I mean, Brazil's still got real interest rates of 8%. I mean, that could come down dramatically. They won't do it until the Fed starts to, or they won't do it in scale until the Fed starts to ease as well. And then I think that has much more impact than other markets in terms of the domestic demand picking up again. On the commodity side, fantastic commodity companies there. But if we are having a bit of a slowdown in the US and globally, commodities might be challenged. But then it all depends on what happens in China, because if China can grow and offset that slowdown, well then, particularly in specialist commodities, that could be a good area.
Well, the political side's always important, and I guess when I look at Eastern Europe and the Middle East, I just say mired in military conflicts, and that's just too much risk. Is that an overreaction? Is that an oversimplification of the problems there or the opportunities?
Yeah, I mean, I think I'm surprised that the risks of those conflicts haven't caused more volatility across the market. I mean, they have in certain areas like grain and oil. And I suppose, going back to the beginning of the Ukraine conflict, Europe was priced to be in a deep recession. And the stock market was according, had fallen a lot. And then actually Europe managed to avoid, particularly Germany managed to avoid a recession, and that caused a massive run in the stocks. So, there isn't that much priced in terms of deterioration in that conflict, which is surprising. And then in the Middle East, I think that, if you look at the oil price now, you'd have thought actually everything's good in the Middle East, but the oil price you'd expect to have been a lot higher, and so maybe the oil price is more reflecting what's happening potentially in the economy and the slowdown rather than what's happening in sort of geopolitical risk. But I think these conflicts are the outcome of these conflicts are going to be incredibly important, Robert, in my view, for what happens going forward, because it doesn't seem like any side is really making progress in Ukraine and Russia, and at some stage there will be a deal. I expect, hopefully sooner rather than later, and that's going to make that could be actually a moment that pulls international players together, and we start to get a friendlier political environment.
And it's ironic, isn't it, that China at the moment is probably one of the greatest sources of fiscal spending there. And we've also, I guess, just recently seen a bit of a rapprochement between China and the EU around some trade issues, which brings us back to China, which is the elephant in the room. And I guess everybody's waiting for some kind of catalyst, but is there reason for the patient investor to be already in China?
I mean, I think there is. I mean, if you look at one part of the world where we haven't seen the recovery after COVID that we have, companies that are clearly trying to change their cost structures, that valuations are attractive, that has complete diversification from the rest of the world because it's underperformed, the rest of the world has outperformed. It's got to be China. I think we still probably have to be more patient. I can't see a big bazooka coming out. As I said, if you break down China into the three simple blocks of manufacturing, property related, and consumer, manufacturing, China sort of peaked during COVID as a share of global manufacturing. It is reliant. It's not a China thing that China can. I mean, the currency's so attractive now that it puts us in a very good position. But the two factors that are really dominating the manufacturing are the demand from the West. I mean, China can't change that, but also the China plus one, that people are trying to diversify their manufacturing. So it's hard to see that being a real driver going forward in the next year, given our sort of economic scenario. Then on the property side, I mean, I think it all comes down to domestic policy and property, to be honest, because property is hurting the confidence, I think, of the consumer, and so the government could certainly, that's the area they need to focus on. It's really difficult to have, if you had a big fiscal stimulus in China, you'd have to have sort of 5% of GDP, which is a huge number now, and I'm not sure whether fiscal stimuluses like the past, like it happened in 2009 and 2015-16, would be as impactful now with the size of the economy. But certain measures can be there to change the confidence of people. There's a huge saving rate in China which has not been utilised, but I think it comes down to the fact that in China people have always accepted or thought that property was a very safe investment, that it generally goes up, and now that's been challenged over the last year or two, and especially with problems in the developers. Now, if that can be stabilised, if the government can give a very good signal that we're getting to the bottom there and this has been sorted out, and that the property prices stabilise, then I think the confidence will come back in. I don't think any sort of consumer stimulus will do that, because if people aren't confident, then they won't spend. I think we need to be looking for the comments on the private sector. I mean, we all know that China needs the private sector. It needs the private sector because it wants to be it wants to have superiority in technology, and it can't do that just with governments. It also wants more employment, and that's where the private sector comes in. And it needs innovation, and yet again, innovation generally comes from more private sector.
Yeah, I can't take my eyes off the Hong Kong market, Sean, because it suffers from the high US interest rates through the currency board regime, and at the same time you've got a weak China. So if we get falling rates in a recovering China, that's probably going to do better than most. Let's chat a little bit about India, because I've always struggled with India. I appreciate what Modi has done in his reforms, the infrastructure bill that he started, the recapitalization of the banking system, and yet it always, every time I look at it, it looks expensive. So what am I missing? How should I approach it?
No, I mean, I think over the last 10, 15 years, I've always said India is the best opportunity in Asia. And, clients would say to me, well, yeah, you said that last year, Sean, when's it actually going to come through? And, I do think that, the last year or two, it's probably beginning to come through, but it's not without its challenges. I think the real change in India is now the willingness of the government to reform. I mean, you can see the infrastructure being built, etc. But the governance is still quite difficult, and I think a lot of that's been that those companies reflect the economy, the changes in the economy better than maybe the large cap indexes. And secondly, you've got the full power of the local industry, fund management industry, that has flows in, fairly similar to what's happening in Australia, in terms of the sort of superannuation systems. And that's been really, really positive. So it's really been a domestically driven, rally. Actually, foreigners have lower levels in India than they had a couple of years ago, probably because the EM's been out of favour and India's probably been a little bit tarnished by that. So there is a lot of potential, but valuations are interesting. That they are expensive. So one would expect some sort of consolidation there. Politics could be one of the reasons that sort of stalls that short term. But a couple of weekends ago, the BJP was expected to maybe have a bit of a wobble in the regional elections, but came out actually stronger. So that's a positive. But I do think that people are beginning to discover the structural story of India. The market cap, the percentage of the market cap to GDP, GDP to income. You're really beginning to see a widening out of the economy. But I just think you have to be quite careful of when you enter India in terms of valuations, and also what areas.
We've sort of glossed over some of the smaller economies, the ASEAN, outside of Indonesia, really been in the doldrums for so long. Is it even worth bothering about them, or are there areas that you would look to pick up some opportunities?
Well, I think Indonesia is a mini India. Maybe short term, the markets had a good run. Election coming up, that's always produces some volatility. They've still got fairly high rates, so they probably won't come down as quickly as people think, and that's a little bit of a choke on the consumer. And the commodity side, which is one area where there's been a lot of investment into India, particularly in renewable commodities that provided for the new renewables, like nickel. You've got to think that maybe with a bit of a slowdown in China, not yet just into second gear, not fifth gear, that maybe expectations are a little bit high there. But I do think the structural story in Indonesia is extremely good. Other markets are still struggling from the pickup from COVID. Thailand, Malaysia, Philippines have been a bit hurt by politics. But I think the one thing that's really hurt them really has been China. Is that trade in China has been pretty weak there, and so has tourism, and they've relied on that. So they can recover quite quickly once China recovers, but I'd still be a bit cautious on them at the moment.
One of the things that people forget about us, Sean, is that we actually do a lot of our investments in developed markets. I mean, not only Hong Kong, Singapore, Australia, but also actually in our portfolios, we will hold some multinationals if we think they're exposed to our universe. But I guess the other developed market that we haven't really touched on at all is Japan, which has had a phenomenal earnings record over the last few years. It's probably kept pace with the US. And people sometimes throw this word Japanification around as if it's a really bad thing. But I think there are a few countries that would like to Japanize at the moment. So Japan clearly over the last few years, starting with Abe, has done some things right. And are these structural or cyclical, or how do you think about Japan going forward?
I think, look, Japan's gone through a major change. And it's interesting when you sort of think back to Abe, and Abe put in, the three arrows. One was monetary reform, one was fiscal reform, and the third was structural reform. And people were very disappointed with why didn't the structural reform not happen? And we had a massive run when Abe came in, but then it faded because yet again, maybe a bit like the China rally last year, valuations went up, but the earnings didn't come through. And I think the question is, the question is very valid. Why did it not come through quick enough? And maybe you could even relate it to what's happening in China. Structural reform takes time, and it also takes a change of attitude as well. And I think what Abe had laid down and Kishida's continued is that reform is continuing, and it's now resulted in a much better ROE. I mean, still a low ROE of around sort of 9-10% from about 4%, and the earnings have been a lot more stable. People have been focusing on their non-core, on getting rid of non-core activities. They've been focusing more on costs. They've been using their balance sheets better. They've been paying dividends. They've put in the stewardship code. The corporate governance is better, and the stock exchange is encouraging this in terms of a name and shame index. That if your company's not being good and going forward, then we take you out the index. But now I think we're having a real change, and the locals are participating more. Previously, it was just the government and main institutions. Foreigners are beginning to look for that sort of diversification and adding into Japan, and really trying. The investment banks are majorly trying to up their coverage of going down from the big caps to the mid caps, etc. And the expected flow of funds into Japan is huge. I mean, I'll just give you two figures. One, Japan has changed their savings plans, a bit like India, a bit like Australia, and what system is called the NISA. You'll probably get $150 billion in the next 3 years going into the market from Japanese investors, which is huge. And if foreign investors were to go from an underweight to a neutral in their portfolios, that would be well over another 200 billion. And so there is tremendous potential for fund flows to go in there. The next part of Japan is about the currency, and the currency has been incredibly weak. Interest rate policy has been the opposite to what you've been talking about at the beginning. It's been incredibly accommodative. It's got inflation from sort of zero to picking up, and now is the time where they can stabilize that, and that's going to have an incredible impact on the earnings of domestic companies like financials, property companies, the consumer, and I think that's very, very positive.
Gone through a lot of our markets, and we haven't really touched on in any detail on the geopolitical environment. I tend to think that's a good thing, because I think things are more driven by what's going on in the countries themselves. But it's an interesting political year, not just because of the ongoing environment between the US and China and the various conflicts, but we've got a few elections coming up in some of our target economies as well. So is this a year where domestic politics gets added to geopolitics, and does that make it better or worse?
Yeah, I mean, this year we have, going into next year, we've got the combination of, for us, India, Taiwan, Indonesia, South Africa, they're all going to be quite key for what happens in domestic policy. Then we have, the US election. That's obviously going to be very important in terms of, political relationships between the US and China and the rest of the world. And, I think that's also going to be important in terms of the interest rate policy as well, and how that's affected. Whether interest rates come down quicker because it's an election year, or not, and where the investment will be. How do we do it? I mean, everything I think is written into the PE, and so if you've got you break down the sort of PE or the risk premium of something like China, I'd sort of tend to divide it between one part of it's geopolitics, one part of it's economic growth, and then one part of it's sort of long-term structure is what's the government's attitude to the private sector and what's the risk within that. I think one has to be quite careful on valuations as well. So I think that gives us opportunities for good alpha. But at the price it's at the moment, we've got a lot priced in for political risk to go wrong. And I think that's the sort of way of looking at it, where, China's so cheap, the political risk is already discounted. India, we're talking about, and Indonesia, they've got quite punchy valuations. So, you've got to look at it, I suppose, on three bases. You've got to look at what the valuation is and what the political risk could affect the valuation. And then you've got to look at it more fundamentally. Any political change, how will that affect FX? And how will that affect monetary policy going forward, and the overall environment for doing business?
Finally, Sean, let me ask you, what do you think you'll be talking about a year from now, December 2024? What do you think will be on top of your mind?
Yeah, I think that we'll probably have a sort of year of consolidation in Asia and Japan this year, in terms of, we still have a little bit of uncertainty in the US fiscal policy and interest rates and where the growth will end up. But I think, Asia will, we'll be talking about the resilience of the GDP. We'll be talking about the resilience on the earnings side. We'll have got through some major elections, and I think we'll start to see earnings pick up across the region, and cheap valuations. And I think that will be the talking point. I think there'll be more people looking really seriously at Asia next year and going forward, and identifying those good opportunities. I think India will continue to grow. I think we'll be talking about that we really have a structural story there. I think China will have picked up a bit, and we'll have seen, we'll look back and go, well, yeah, that really was the bottom in China. Although, it had a few false starts. And I think the Japanese story will be, much more well known, will have broadened out as well. And I think you'll begin to see, the local retail investors, either through the pension funds, insurance companies, or direct, starting to add to the market, and people putting more money out of the US into Japan. So I think those will be the major talking points. And hopefully we can talk about, a better geopolitical environment, particularly between the US and China, because, we must say at the moment, we're probably at the bottom of the confidence range on that.
Well, I hope 2024 turns out like that. We're seeing a few encouraging early signs, as you mentioned, on the political side as well as the economic. And for many of you out there, this will be your first introduction to Sean. Throughout the year, Sean will be updating you on his macro views, and things never turn out exactly as you think they will. And where we see things changing direction, we'll be sure to let you know. But until next time, thank you very much.